A very warm welcome to today's panel discussion on the topic of investment management and a day in the life of an investor. My name is Caroline Holtman and I will be moderating today. Just for context, we typically give these talks in person at schools and universities, but we're thrilled to have been able to continue our program online. We did our first virtual talk earlier this week with great success, and we're very excited to have so many of you on the line for today. On a related note, I just wanted to say huge thanks to all of our partnership societies and universities for spreading the word and for all of your support. So some of you may be familiar with GAIN as an organization and some of you may not. So before we jump into the discussion, I just wanted to give you a very brief intro to GAIN and myself before introducing our talented panelists. So as I mentioned, my name is Caroline. I am an investment analyst at a highly philanthropic single-family office here in London. I co-founded GAIN in 2018 together with a group of other women in the industry, one of which is on our panel today. And our aim is really to inform and inspire young women about the many highlights of investing as a career. I personally think it's one of the most interesting and rewarding career opportunities out there. And I hope that after this hour, you will have gotten a good flavor for why. I'm very excited for today's discussion because we have three incredibly talented and interesting women on the line. So let me quickly introduce you to them before handing over to the panelists to give you a bit of more background on themselves and what kind of investments that they make. So first up, we have Tatjana Greil Castro, who is a fixed income portfolio manager and board director at Muzinich, which is a privately owned investment firm specializing in corporate credit. Do you want to give a brief intro, Tatjana?
Yes, hello everyone, and thanks Charlotte for introducing me. Yes, I have been working at a family-owned asset manager called Muzinich & Co. for the past 13 years. I'm originally from Austria, so I studied economics and then came to the UK to do a PhD in economic history. I chose a university in London because I wanted to work whilst doing my PhD, and so I was an economic assistant first, and then applied for investment banks, went into research, and then actually was made redundant during 2001 with the sort of internet bubble bursting, and then clearly there was the World Trade Center being attacked. So that was a difficult time in the market. Just to mention, these things not always go rosy. They can take turns that you don't expect. But I was actually quite grateful because my colleagues helped me to find a job, and I then moved on to the buy side, as they call it. So sell side is the banks, buy side is the investors, and worked for a number of insurance companies. And then I joined Muzinich. And my focus has always been since my career. So I studied economics, but then my focus has always been corporate credit. So lending money to companies. That's me.
And then on the line, we also have Caroline Shaw, who is head of fund and asset management at Courtier. Do you want to give a quick intro too?
Yeah, thanks, Caroline. My name is Caroline Shaw. I am head of fund and asset management and inherently a fund manager at Courtiers. We're a wealth management business, which means that primarily we're helping individuals, some smaller corporate organisations to manage wealth. So my background is actually as a civil engineer, but I've been running money like this now for 20 years. And I came through the wealth management side into fund management. So a lot of the qualifications I did prior to investment management qualifications were around the tax side and understanding wealth and how people approach their decision making. So I guess it gives me a slightly different perspective on wealth, on fund management. Nowadays, we manage about 700 million in assets for clients on a multi-asset basis. So across the spectrum, equities, bonds, cash, currencies, commodities, infrastructure, anything that's out there globally, we can invest in it. So it makes the job very varied.
Great, thanks, Caroline. And then finally on the line, we also have GAIN's co-founder, Charlotte Yonge, who's a fund manager at Troy Asset Management, where she manages the firm's ethical fund.
Yeah, thanks, Caroline. So I've got the great joy of working with Caroline on GAIN, along with the rest of our team. And yeah, my day job which is at Troy, is running an ethical fund, the Trojan Ethical Fund. I also work on another multi-asset fund. And really what we're trying to do, first of all, is not lose our clients' money. So there are lots of ways that you can invest. Ours is very much a safety first approach. And I've always liked that style of investing. I suppose my first experience of investing was in 2008, which was quite formative, when I interned while I was still at uni. And that definitely led my view of what should be done and how people should do it. And there were a few people in 2008 who didn't lose money. I went to work for the first one of those, that limited number. I went to work for one of those companies in 2010 when I graduated, called Ruffer, and that was a wealth management firm. So like Caroline, that's where I started, and I realized actually I quite like getting into the nitty-gritty of research. So I moved to Troy in 2013 and became an analyst there, and then became a fund manager 3 years ago, and haven't really looked back. So yeah, I'm looking forward to talking more about a really fun job that I really enjoy.
That's great. And just picking up on a topic that's very top of mind for students these days, Caroline, you mentioned to me earlier when we were speaking that you studied engineering, but then you ended up in investment management. Can you tell us a bit about that transition, how investing, initially came about, and what caught your interest?
Yeah, I guess it's not the most obvious transition, but when you look at the skill set of things that are required in my day job now, having studied engineering and got that logical project management organization background, that actually is very helpful. So I did civil engineering for a few years after I graduated. I worked on some building sites around London, really enjoyed it, but I decided it wasn't going to be a forever career for me. So moved out of that, traveled for a short while. And then when I came back to the UK, it was just prior to the IT bubble. So we were in 1999 and everything was all about finance and IT. Those were the really exciting careers to be in. So it's probably no coincidence that myself and my then boyfriend, now husband, went one way and the other way. He went into IT, I went into finance. But actually probably stems more from talking a lot to my father over the years. He's always liked investing. So a lot of those conversations at home were around investments. And so really I just took an opportunity. I started work on the 3rd of January 2000, which was kind of the first day after everything went wrong. So wow. Really pretty much 2.5 years after that of a very, very difficult introduction to the world of managing money. And in a way, that reflecting on that now, I think that's a really good way to start, because it starts hard and you really have to take care of people's money, look after it, because things are going wrong and you have all the difficult questions then. What some of people don't do is ask the difficult questions when things are going well. And actually that's probably when you should be asking the difficult questions of your investment manager. So I learned it had a baptism of fire, if you like. But the transition was tough in that, because I was already part chartered as a civil engineer. So then I had to start all over again. So I spent the first few years doing exams, retraining. So I did some Chartered Insurance Institute, wealth management type exams for a couple of years. And then I went on to do my CFA charter. So there is no escaping the fact that you need professional qualifications. I just probably did those a little later than maybe somebody who decides straight after graduating. But in a way that I think that's an advantage. And all the skills you learn through A-levels university can be tailored towards your future career. So any report writing, research, part of my degree, like every degree, is doing a dissertation, doing some research. My day job now is doing research. A lot of what I do is reading and research, and so it translates very well. There's a very transferable skill set into this career. It's a vastly broad career to adapt things to.
That's very helpful. And then you, Charlotte, I know you haven't necessarily studied quantitative subjects, which is something that we know many students assume that you have to do to get into investing. Can you describe what you studied and your journey into investing and how you adapted?
Yeah, so I studied Latin and French, which people find quite surprising. But actually, if you look at our team and a lot of the really great investors that I know, there are a huge number of historians who seem to be very good investors. The person I first worked for, Angus Tulloch, he is a historian. Nick Train's a wonderful investor. He did history. And in our team, we have a historian, we have a geologist, people who study politics, zoology. I obviously did languages. Tilly, our founder, is an English graduate from Oxford. So really, it's actually, there are lots of ways to skin this cat, and it helps to have lots of different disciplines feeding into an investment process. We like the fact that we all bring different points of view. I work on a team with an electrical engineer, which is great because A, he knows exactly how to fix the computer when it's not working, but B, and create really complex models that he's running on huge amounts of computing power. But B, we come at a problem from totally different angles. And so with my French and Latin background, that was a really logical subject. Latin's a particularly sort of logical language, but it was also very analytical. I studied lots of literature in my degree, did lots of essays. Communicating is a really big part of this job. So the analysis and the communication that I did as part of the undergraduate are really helpful. And it does, we were discussing this at our last panel, it really helps if you can write and you can tell a story, because a lot of what we're trying to do as investors is find compelling narratives. So is this a brand that really speaks to consumers, and is it going to be a lot bigger in 10 years time? And that's not something that you can put a number on. There's never one right answer. But if you can understand how consumers' minds work, and you can understand what makes a really compelling business model, a lot of that is more qualitative. And then you need to communicate that to whoever the fund manager is or whoever the client is, to make the investment case. So lots of skills needed for this job. So there's no one right degree. And I didn't do maths A level, which I started doing, and then I decided I didn't want to do 5 A levels, so I gave it up. So you do need a certain degree of numeracy, but frankly, you're not going to learn that in textbooks when you're in sixth form. Like Caroline, I've done lots of exams, and there's a certain type of numeracy that is most applicable to this job, and you can learn it on the job. You need to understand what makes a company profitable, but ultimately you can't be too quantitative, otherwise you miss the big picture sometimes. So it does help to have a different background and bring a different perspective.
That's really helpful, Charlotte. And then I'm just reflecting on your presentations earlier, and if you take a step back and you look at the investment management industry, it's a wealth of different types of firms, different types of clients. Tatjana, would you mind giving us just an overview of the different types of investment firms that are out there, the role that they serve in society, and who your clients are?
Yeah, that's a great question, actually. Before I start, for instance, when I started, my family, they don't work in finance. They're all engineers. So I was the first one to really venture into it. So I didn't have anybody really to reach out to. And when I was at university, then most people applied to big firms where, sort of they've heard of. So there would be investment banks, or it would be consultants. I think actually asset managers, they are less well known. So people don't really consider that as a career choice. And I think it's not unusual to see a career like mine, where you start at a big sort of investment bank that everybody has heard of. That was back then Merrill Lynch. And then only later then you go into, as you know the field better, you go into this. So please, reach out, use this as an opportunity. Now also you have 4 ladies here that work at different firms, sort of to create that network, because there are smaller firms out there. They're very entrepreneurial, and you can learn a lot. So for me, my own thing, so is you can go to the insurance companies. So insurance companies, what they do is they collect their insurance premium. Some of it clearly gets paid out if there is an accident or whatever you get the premium, but a lot of that money doesn't get paid out. And so they invested money to make it grow. As they are developing this expertise of investing this insurance premium, they then also start to collect third-party money, so from other investors, where they say, look, we've already built this expertise, we may as well invest in other funds. So, you know, here in the UK, for instance, one very well known would be Legal & General. It's an insurance business, but there's Legal & General Investment Management. That was one of the firms, for instance, I worked for. But there are many of those out there because they use that experience to then also manage third-party money. And then clearly we have asset managers where they're purely focused on asset management. They can be publicly owned or can be privately owned, where I work. They can be very specialized. A lot of them are. Some of them are huge, like a BlackRock, for instance, where they do a lot of passive investment, but they really are from equity to credit to commodities to currencies. So when you go into investments, there are plenty of opportunities to choose from. This is a very varied field, and it depends a little bit then on, you know, where you want to be. Then it was already pointed out, some people start then as analysts. We have people in the firm that started as in client servicing, so they were on the sales marketing side or on the risk side, and then they realize that there's this opportunity out there on the investment side. So there's many ways also to enter investments. You don't have to, you know, nobody starts as a portfolio manager. But you know, see openings within, because you will be able to maneuver. And if you show interest and be proactive, there will be opportunities. So I think that's the other thing to consider. You don't necessarily need to find your dream job as your first job. But if you like the company, then you have a foot in the door, and then you know, as they get to know you, you will be able to create opportunities.
Very much agree with that, Tatjana. And then Charlotte, just touching on something you mentioned earlier about managing Troy's ethical fund, I think it's an incredibly important topic for many people today, and probably for most people that are on the line. Could you give us a bit more color on, you know, the importance of investing to society? It's a common, you know, misconception that investing is just about making rich people richer, which certainly I don't think is the case.
Yeah, it's a great and very topical question. So I think people underestimate how much you can do as an investor and how much of an impact you can have. And particularly, you know, I'm invested in large liquid companies, and people say, well, are you really going to change the world by investing in some of these multinational businesses? They're not the ones who are at the vanguard of creating new renewable technologies or putting in place, you know, potentially a new water system in various emerging markets. And there are aspects of responsible investment which are very much at that kind of frontier of making a change. I think what's quite important to remember is that the vast majority of the world's economy is made up of big players. And what we do as investors, and what we are increasingly doing, because everyone's sort of woken up, I think, over the last particularly 3 years and realized this is just the right thing to do, and it makes business sense. We're holding these companies to account in a way that previously just it wasn't widespread, and it wasn't mainstream. It was kind of like a niche where the responsible investor was some sort of niche fund that might not give you very good returns, and you know, maybe it's good for a charity or so, or for a real tree hugger as a client. And now it's mainstream, and it's because people realize that businesses can't just continue without regard to society and without regard to the environment. There is an onus, and this has been placed by consumers and by regulators as well. Consumers say, I'm not going to buy your products unless you're doing the right thing. Regulators say, we're going to come down hard on you if you're not behaving responsibly. And where we come in as investors is we actually have to anticipate where both of those, where the regulation's going and where the consumer's going, because ultimately we want to make more money for our clients. And if you're invested in businesses that are on the front foot when it comes to doing the right thing for both of those parties, then they will be more profitable companies, and they will be the businesses that see the most growth. So what we do is we engage with lots of companies. Some of them are really big. So for example, Procter & Gamble, I invest in. And we had a meeting with the CFO, and we were holding him to account on plastics and saying, you know, what are you doing as one of the largest plastics producers in the world? What are you doing to ensure that that's recycled, to ensure that we move to a circular economy that actually sees plastic be used multiple times, not just single use? And that makes a difference. Those types of engagements from a number of shareholders gain critical mass and actually start to move the needle in a way that if you were not to engage with these big companies, it would be very difficult to do. I mean, plastics is an issue where it is concentrated amongst a handful of players. So we can have an impact. And the same comes with climate change. And actually, I went to a really good conference where Mark Carney was speaking, and he said, look, regulation will happen when it comes to carbon emissions and reducing the carbon footprint, but it's going to be slow. So we need investors to act first and to intervene so that companies reduce their carbon output before they are mandated by the regulator to do so. And he now works for the UN. Clearly, he had huge influence in shaping a lot of the regulation in the UK. But that it's our job to get these companies to move before they have to. And if they don't, then we can sell the shares. But it's that engagement part of being an investor, that two-way dialogue where we say to the companies that this is what we want to see, and we're going to keep asking you about this and keep monitoring your progress until you get there. And if you don't, then you know we don't want to be shareholders. So it's a really sort of constructive and ultimately high impact way of investing, and that's how we think about it. No business is perfect ever. Everyone's on a journey, but we want to see the direction of travel and the rate of change going in the right direction.
Thanks, Charlotte. That's really helpful. And the investment management industry is very diverse, and we heard you all talking about the various niches that you specialize in. And we've gotten a question from the audience asking about how your day-to-day life varies whether you work in different industries. And I'll save that to slightly later, but I thought, Caroline, I'd be very curious to hear, because you cover a broader portfolio of different types of investments. Could you give us, just an example of different types of things you look at and how the process differs, and how the analysis that you do on each of these investments differ?
Yeah, sure. And you're right, it does differ. And I think if I try to pick a typical day, there is no typical day. And that's the one thing that's quite exciting. So one of the things I've already done today is had a call with some pension trustees. So actually speaking to the end user of these investments and trying to explain what we're investing in to the layperson, if you like, which is a different conversation than you would have with your peer group or with a professional investor. So I think, Charlotte said earlier about communication being very important. That is true. So we look at equities, obviously, and I've just chaired our asset allocation meeting and had a huge discussion on our equity model selection at the moment, because of course, with so many companies cutting dividends and with earnings hit so hard in the last 7-8 weeks, some of the quantitative data is skewed completely as to what we were looking at maybe 3 months ago. We've got a guy on the team who's built quite a lot of quants models, which we use, and some of those are showing some very skewed data at the moment because of companies reporting and lots of cancellation of dividends. So one of the challenges we're facing today is how do we maybe adjust those equity models to account for the short term? And that's just on equities. When we look at infrastructure, for example, that's something we outsource to a third party. So when we invest in equities, we invest directly. But infrastructure, we're not going out to buy a hospital, a school, a road directly. We're using a third-party manager to do that for us, and we're part of a wider pool of people investing. So then it's more of a case of a manager due diligence, making sure that the managers we use are applying the criteria we like them to apply, or managing it in line with their mandate. So it's more of an overview of what they're doing and what they're invested in. And then if you look at, say, something like commodities, it's much more looking at what we're allowed to invest in with regulations, because the regulatory rules on listed funds are different for commodities than they are for other asset classes. So what are we allowed to invest in? How can we make sure that's a diverse investment? So maybe a lot more around the rules and liaising with our internal compliance team, as well as then looking at the underlying asset. So last week I've been doing quite a lot of work on oil and the oil price, and could we capture the upside in the oil price if there should be an upside from its current lows, and why the oil price is, well, why did it go negative for WTI last week, and could we have captured that? Why did Brent not go negative, or it went very low? What are the issues with investing in, say, an exchange traded commodity at this point, where it's looking at the roll yield on the futures market? So there's a lot of nuances to each different type of asset. And actually that's what makes it so interesting. And I'm not necessarily an expert in any of those things, but I can do my research like anybody else. And we're looking at those opportunities that spring out of the current market situation. If we look back to what our portfolios looked like in February, they were different to today, because we held a lot of options going into the market downturn in late February, and equity options on equity indices were really helpful because they were very defensible. We had call options, very defensive, but of course then the VIX index spikes, so volatility in the market goes really high, and then those equity options are really not viable for us at the moment. They're very expensive. So then we're looking at, well, how do we get our maybe some core equity exposure if we're not going to be using equity options. And then we're looking at maybe we've used some futures, we're looking at some direct equity opportunities very specifically. So it is different for each asset class, but it's not a completely separate skill set. They all interrelate. And certainly, if you look at the side of, say, a company issuing a bond, it's very important to understand that company from an equity perspective as well. The balance sheet of that company is important from both sides. So when we're looking at fixed income as well, and companies issuing bonds as well as governments, we're looking at that too. So it does provide a lot of breadth. I think the one thing I'd touch on with the question you've got, and I'm sure you'll come back to me, Charlotte talked a lot about talking with, she's an investor investing in a company and engaging with the companies. And we do that to a certain extent as well. But we're also engaging as a wider business, not me personally all the time, but in the wealth management career that someone could have. You're engaging quite heavily with the actual investor who owns the shares in my fund, for example. Somebody in my business is liaising with that investor. And in terms of social good, and I accept we're living in a capitalist society, but some of our end investors are people who work in businesses where they've been auto-enrolled in a pension scheme and they're contributing £50 a month to their pension. So these are people who are just starting out in their careers, join a company, join the pension scheme, and need to be given advice on how to invest that. And so I might be managing that money on their behalf, but actually it's very important to that person to A, understand where they're investing, but B, start planning for their financial future. So careers in financial planning, wealth management are also for the social good, because I think we all know that the government is not going to provide pensions at a level that most people think that's going to be the case, particularly if you're graduating in a few years' time and you're going to start saving for your own retirement. It's important to understand that, and to be able to, for us to be able to help those people in order to plan for their retirement a long way hence, without the government support that maybe some of the retirees today have got.
Thanks, Caroline. That's really interesting. And you bring up something which is very topical, which is the recent market volatility, which I think in the discussion today, it's almost unavoidable to not discuss. And I'm thinking about you, Tatjana, because you've been investing or been in the industry throughout many market cycles. I think many people think now is a scary time to invest. Could you give us your views on what now is a good time to invest and what you have been up to recently?
Yeah, sure. This actually also brings me quite nicely to sort of another aspect. So, of course, we all believed, Charlotte actually rightly said it's not all quantitative. It gets me a little bit also on, I think one of the questions I saw is, what would you wish would be different in the investment industry? It is very much driven by behavior, by sentiments. And, there is always the fear and the greed. And generally be greedy when others are fearful, and be fearful when others are greedy. And I think, this is really that answers the questions. Now that everybody is fearful, this is when there are good opportunities and you will be able to reap good returns. Before March, so when you look back to 2019, all markets had a stellar return. And it was very unusual because generally, let's say, the sovereign bond market wouldn't do well when the equity market is doing really well. But we had all markets do well. 2018, we were fearful of a recession coming. 2019, this recession is likely to be a few years out, and 2020 will be a great year. And this is how we got into 2020. Most people forget about this. January, February just continued the strong rise in all markets that we had seen in 2019. There was very little value left, actually, in January, February, arguably none. So people always say, oh, now we're in uncertain times. We are always in uncertain times. If you think, let's say, something bad happens, there's an accident, well, things change within a second. If there's illness, you don't think there's an illness one day and the next day you have it. So there's always uncertain times. It's just that we push it aside. It's the same as with fear and greed. We push it aside when we believe everything is going well. But then when things are changing, we think, oh, now it's uncertain. Well, not really. So I would say this is actually, and the past has also, there's lots of studies that show, after a big sell-off, this is when you can make good returns over the next, I would say, 3-4 years. And that's when you see the stellar returns. And that has borne out many times over.
Thank you, Tatjana. And that brings us very nicely into, what it takes to be a good investor, because some of the things that you alluded to are not necessarily, quantitative analysis, which most people tend to associate with the investment industry. Charlotte, what would you say it takes to be a good investor, and how can you kind of practice those skills? What reading can you do? How can you expand your network within the industry?
Okay, yeah. So I see the question on kind of reading and while you're still at university, what you can do, because I see someone asked, do you have any book recommendations? I mean, there are so many books. I would say it's a bit cliche, but everyone should read the essays of Warren Buffett. That's a great one. It's obviously someone who's nearly 90 now and he's still investing. So he's got lots of experience, but also it's a great example of how the job is never done. This is not just a short-lived career. It's something you can keep doing because it's really fun, and you can keep learning until you're in your 10th decade, as he nearly is. So yeah, I'd say everyone should read that. It's just quite a good intro. And then there are lots of podcasts, which is particularly if you're at university, quite helpful to dial into. So Patrick O'Shaughnessy of Invest Like the Best is one of my favorite podcasts. And I'd say that is quite a good example of why, sort of illustration of the fact that there's not one clear formula to becoming a good investor. There are so many different investors out there, and some of them, like I mentioned, are super quantitative, and they see the sort of share prices on a screen and they see the valuations, and that's how they think about investing. For the way that we invest, we think about it like you own a stake of a business. This is a real life company, and you want to own a stake in that for 5 years minimum. You want to look out for the next decade. And in order to be good at that, finding the right companies, you have to have a very good sense of where things are going and ultimately understand what makes a company last. So, and frankly, that is always changing. But if you find the companies with really good brands that are able to adapt, and you're seeing now is a really good time to be able to judge that, because they're having to operate in an environment which across the world is totally unprecedented and is requiring a huge amount of imagination from those business leaders. If you can find a company that can exist and thrive in any environment, so now is a good test, then that is a fairly good formula for finding a good investment. Now, what skills do you need to be able to do that? I think it just comes with years of seeing what works and seeing what doesn't. I think at the beginning you need to be intellectually curious, you need to ask lots of questions, and you need to just absorb everyone else's advice and everyone else's sort of experience of what makes a good business and what makes a good industry. So really just having that willingness to learn, I'd say for anyone starting out, that is a number one thing that can make you a good investor. And then it just takes time, and you get lots of things wrong and you learn from your mistakes. So you got to be able to realize that you're not always going to get it right. And frankly, a lot of the best investors are those that have made some really terrible mistakes, but they've learned from them. And so you do need to be able to be humble enough to do that, but then pick yourself back up again and say, right, well, what's next? I'm going to come back, and I'm not going to make that mistake again. So it's perseverance once you're in it. And ultimately you need to, as Tatjana was saying, you do need to be able to go against the grain sometimes. So realize when you're wrong, but also realize when you feel wrong because everyone else is disagreeing with you, but actually that maybe makes it a really good opportunity because no one else is thinking about it. So you do need a little bit of courage of your conviction, and sometimes being a bit contrarian can pay off. So lots of things that can make a great investor, but I think those are the sort of main things: willingness to learn, humility, ability to pick yourself back up and persevere, and then kind of willingness to be lonely and to be the only one in the room saying something. And frankly, those are the investors who have really succeeded, because as you said, Tatjana, when everyone else is fearful, if you can be brave enough to invest, then that's likely to be the sort of career making move that you've seen from many people, like Warren Buffett, for example.
Thank you, Charlotte. I particularly like your comment about learning from mistakes, and certainly when no one's perfect. I'd be curious to hear, Caroline, what are some of the best investment decisions you've made, and what's an example of a really bad one?
Yeah, it's quite interesting. I don't tend to dwell on mistakes or good decisions too much, because the next day is the next day. And actually you don't have time to beat yourself up over good or poor decisions forever. So it's important to learn, but it's also important to move on. That you think. So things that have gone well we were brave in 2011 and picked up some bank issued structured notes which were bombed out after the financial crisis, and we bought them when they did not look like a great idea, except that we did the due diligence into the banks. We were pretty sure those banks were fine, and we got some bargains, and we made a lot of money for people, but on a very small part of our portfolio, because when the risks are high, you don't go in and fill your boots with it. You just take a small fraction. So managing risk is really important, actually. So when you do manage your risk carefully, you know that when you're trying to be contrarian, you're not jumping in with everything. You've still got to be mindful that this is people's money after all, and that you're delivering people's retirement hopes and dreams, is how I like to think about it. And genuinely, I want my investors, people who own my funds, to sleep at night. I don't want to cause them any stress and worry. So if they're in the right fund, they shouldn't be worrying at night. And that's kind of how I think about it. I might get a sleepless night sometimes. Bad mistakes are things, more macro calls, things like maybe not owning, well, we hedged our currency into the financial crisis of 2008 and shouldn't have hedged it. It would have been better not to. That's a great decision in hindsight, but we thought we'd lower our risk. So things like that. Being long on options going into February this year was a good thing. Currently holding a couple of airlines is not so good, but we own a couple of airlines still. So, but we own ones that we think will come good. And yes, we've been topping them up. So that's arguably a slightly contrarian play at the moment. Not many people, Warren Buffett sold all his airlines, very high profile sales. But we own a couple and we've been topping them up, and we own a couple that we think will still be there when the airline industry re-emerges in 6 months' time. So I think it's important to learn from your decisions, absolutely, and it's important to be brave. But you can't go into work each day and beat yourself up on a bad decision from the day before, because you've still got to make decisions. And one of the things that you find in a crisis is people become unable to make a decision. They freeze from making decisions. And actually, you can't afford to do that. You've got to keep on going. And that's something that experience teaches you. And you can't get that from anything else other than to live through and invest through these crises. And I've been fortunate or unfortunate enough to be in my third at least now. But if you count 2011 and 2015 little blips there, you could argue it's 5. But what we've been telling the younger people in our team in the last few weeks is that this will pass. And we need to look at it and look at the opportunities that are available, because we will come out the other side of it, and so will our investors. And you've really got to get that experience by being in the market. But if you're coming into the industry, then speak to people. You're going to work with experienced people, so talk to them, engage with them, read books, read papers that people have written, and learn as much as you can from people who've lived those experiences. There's actually nothing better than studying a bit of financial or economic history. I know it's Tatjana's background originally, but go back and read books from the 1929 crash. They're really interesting, and they may give you a snippet of something to handle today's crisis. So be intellectually curious about history as well as what's going forwards.
Thank you, Caroline. Tatjana, what are your key recommendations in terms of perhaps books or other ways to read up on the investment management industry?
Well, that shows actually my area of expertise. Now everybody else is in equities, I'm in fixed income. So there is what they call the Fixed Income Bible, and it was written by Fabozzi. I have it. I mean, I have the Fixed Income book by Fabozzi, which I wouldn't so highly recommend, but I have the Fixed Income Mathematics book by Fabozzi, and that's a page turner. I mean, that is everything you want to know about fixed income. You'll get it out there, and it's really. I mean, look, I wasn't a maths genius at school. Yes, in economics you need to do maths and statistics and stuff like this, and I got by, but. I then actually, when I started work, there were quite a few people who did further maths and were just really good at maths. And I tell you, I think I learned the most from them. And because they just explain it in such a simple way, they say, "Oh, yeah, of course, I understand." But anyway, so please don't be disheartened by the bond mathematics. It's really not that difficult. You just need to have an open mind. But yeah, for Fabozzi, I would definitely recommend for anybody who is interested in bond maths. I also wanted to say, because I did work at an investment bank, but in research, and I just briefly want to say, because there's a question about, private equity, venture capital, asset managers, investment banking. When I applied for jobs, I mostly applied for jobs in investment banking. So M&A, those sort of things, as one would think about investment banking. So all the jobs I applied for was investment banking, and then I had one job with an investment bank for research. And people were saying during the interview, you know what, you need to be ready for 3 months of no break. You work weekends, you work all-nighters. Are you willing to do that? And I said, yes, of course I am. Then I got a letter of acceptance. And I thought, oh my God, that's not me. I like working, I enjoy it, but I need a break. I need to be able to go home at night. I need to rest over the weekend. I have other interests. And I then desperately actually called it one company where I had this interview as a researcher, as an analyst. And I said, are you inclined to make me an offer? And they said yes. And I said, yes, please. So investment banking, I think also PE, also venture capital, they do expect you to be available day and night, I would say. I think that's still the case. Maybe a little bit less so than it used to be. A lot of people start their career in those sort of sectors because they're willing to give everything to work, and they then often end up in asset management, where actually the work-life balance, I find, is much better. you do work trading hours. Trading hours are, depending on where it is, let's say from 8 to 5, where the senior you are, the later you start, I would say. But yeah, there are you have free time if you work in asset management. The work balance is very good.
Thank you, Tatjana. We have quite a few questions coming in, and I want to make sure that we get through at least most of them before finishing at 2. We got one question, which is, what do you think are the biggest barriers preventing young women from breaking into the investment management industry? Do you want to take that one, Charlotte?
Yeah, so as part of GAIN, actually, we've done a lot of work surveying young women to find out, A, if they're interested in going into investment management, and B, if they're not interested or if they're put off, then why. We found that actually the first thing is knowing what it is. So that's really helpful from Tatjana to hear what investment banking is versus investment management, because people lump them together and they think that banking equals investment, and therefore if you sign up, you're not going to have a life. You maybe are going to be on a trading floor. People have a sort of Wolf of Wall Street impression of investing, which is just so far from the reality. The places that I've worked, it's much more like a sort of university library where everyone is, I have to say, it can be quite nerdy, which I think is great. But it's, you know, it's really thoughtful people working quietly on stuff that's they're really interested in. So it's very much, it's a far cry from anything that is particularly testosterone fueled or macho. I think that's the first thing. And as we've said, you don't need to be a maths or a quant whiz to get into it. And another thing, you know, we see lots of humanities subjects that women study and they think, oh, it's not for me. Well, it can be, and you need a degree of numeracy, but that you can learn if you are inherently able to do pretty straightforward numerical stuff, and you know, that is just one part of the job. So it is actually a much more varied and a much more long-term and thoughtful profession than people know. And the second thing we found was that there just aren't enough high-profile role models that are relatable. So part of doing these panel discussions is to show that there are women like Caroline and Tatjana who have had incredible success investing, and they've done so whilst being relatable, nice and inspiring people. And I think, you know, you don't necessarily see women standing up and shouting about their achievements, and as a result there isn't really a spotlight on a lot of these really successful female investors. So we're trying to shine a spotlight on them to encourage more women to apply.
Definitely. Thanks, Charlotte. We have another one, which is, and it's highly topical in today's environment. If we could share from our observations and experience what type of investors or investment models that are more resilient in challenging times.
I can maybe say something to that. I think everybody agrees. You need to show a process that works and it's repeatable. It's not about staff fund managers, you know. You see quite a few hedge funds where, you know, they got, I don't know, the financial crisis right, or they foresaw the coronavirus. I mean, that's a one-trick pony, and sort of, you know, getting lucky is being sold as expertise. As Caroline said earlier, you don't bet, you know, your house on one investment. One of the important things is also that you are well diversified. You know how the different components in your fund work together or against each other, so that you may have some winners in a certain market environment and others are losers. But if the environment turns, then those losers turn out to be winners and the other way around. So you need to know how the different components in your portfolio work together. And yeah, and then it's really a team exercise. I think we haven't spoken about that yet, but it is a team environment. Nobody can do it on their own. So it is very important to rally your team, to have good people around you, to have discussions, to listen, to input, make the decisions together, clearly have good accountability. So in the end, I mean, the portfolio manager is always to blame. I think that's what I live by. I think it's very important in your leadership role that you never blame anybody else. It's always your fault. But you know, shower people with praise to the extent is, because everybody wants to do right. It doesn't mean that things always work out the way you had planned it, but then it's important to pull together to get yourself out of that hole that you have created yourself. So yeah, it's process oriented, repeatable, and a team structure. And I think there was one question also, what are you looking for, you know, when you are interviewing? I think it is, can you relate to those people? You will spend 10 hours a day with them. You will spend far more time with them than with anybody else in your family, day in, day out, and there will be tricky situations. Will you enjoy, you know, sort of that time with those people that you will be working with? I think that's the most important, and where you feel you can learn from them, and they're honest and serious and are willing to share, and not grabbing everything for themselves. I think that's important.
I agree. Thank you, Tatjana. I think fun question in the forum is, what are the key factors to consider when deciding which investment management firm to work for? You want to take that one, Caroline?
And I think it works from, it's a two-way thing, a job and a recruitment process. And I think Tatjana alluded to it exactly right there, that, you know, we look for people. When I'm recruiting, and I've recruited 2 analysts in the last 6 months, which is unusual, it just happens to be like that. But I'm looking for people who fit my existing team, who are going to contribute in terms of someone with a different background, a different education, who studied something different to everybody else in the team, so we get that different perspective. Someone who's not afraid to speak up, but is not, you know, like a bull in a china shop. Someone who's going to sit back and absorb and listen and learn, but then who will contribute to the discussion, and someone who we're going to get on with. So when you're looking for an investment firm, you know you're going to spend all day, every day with these people, and you really have to gel with them. So when you go for those interviews, make sure you're being interviewed by the people you're going to be working with, because actually it's a massive decision joining an investment firm. It sets you off on your career path, and you can move, of course you can, but you don't want to move within the first few months if you're hating it, because there's a real personality clash. So try and meet the people you're going to work with. First impressions do matter. You do get a good impression from people if they're welcoming. We tend to interview with only 1 or 2 of us in the first interview, but when it gets to the final stage, we're all in there, the whole team. The person gets a chance to meet us all, because it's really important that they gel. So look for people who've got similar values to you on those conversations, because maybe some interests, shared interests as well, that helps too. So although people say, you know, putting interests on your CV doesn't matter, sometimes it really does. If you've got a shared interest with the people in your prospective team, that counts for a lot when you're spending 10 hours or more a day with somebody and you're commuting to get to that job. You don't want to be dreading it, because you're going to work with people you're not liking, even if you like the job. Actually, the job could evolve itself. You know, Charlotte said earlier about, you don't start as a portfolio manager, you make your way up. I didn't start as a portfolio manager. I started in a technical paraplanning role, writing reports for clients about taxation and a bit of investment planning, but it was not a portfolio management role. So you're going to start in one place, and you can move your job around within an organization sometimes. But if you don't like the people you're working with, you're going to be miserable from day one. So that personality is really important, and being able to be confident about what you will bring. Where are your strengths? You know, what do you bring that's different from other people? So one of the people we've recruited recently had got a bit of a credit background, so that was helpful. That was new for us, so that was a good attribute to bringing in. But we did take a new graduate on, but he'd done some work on property in his done a master's actually in property real estate management, and that was a new field that we thought, actually none of us have that really specific deep knowledge. That's a really good attribute to bring into the team. It wasn't the deciding factor, but it helps. So if you have any attributes, or you've studied something, or you've done a dissertation on something in particular, or you've got a master's and it's a specialist subject, those things can actually add value to a team in the right place.
Yeah, I would definitely reiterate that it's all about people. And then maybe this answers another question that we haven't really dealt with yet on the Q&A, which is wealth management versus asset management. Because if you're deciding which part of the industry and which firm you want to apply to, it is, as Caroline says, you can transition. Sometimes it can be hard, though, to transition, particularly from wealth management to asset management. So I thought, and I was lucky that I did this, partly because I'd done an internship in asset management before and then went back to work at Troy. I already knew, but I think it is hard to make that leap. And so I would say the difference is when you're deciding whether you want to go into wealth management or asset management, wealth management is much more client facing. So there will be quite a large component of your job, which is almost relationship management. And for some people that is brilliant and they're very well suited to it, and it can be incredibly enjoyable. And there is, if you're thinking about your day-to-day as a wealth manager, you're managing lots of individual portfolios for clients, and they might be bespoke, and you need to remember that this client doesn't want to own any oils and this client has a big tax burden, so you don't want to realize any gains because they've already got a big tax liability this year. Things like that, which are a little bit more perhaps detail orientated towards the individual. And then asset management, we run, and this is how most asset management firms work, big open-ended funds, which we don't actually meet the end individual. We rarely meet the end individual invested in those funds. So our relationship management is not a big part of the job. I will meet clients, but they tend to be intermediaries or larger institutions. And actually the bulk of my job is not relationship management, but is researching the companies that we're invested in. So it's much more research orientated. And within wealth management firms, you will find research teams, and you can, if you start in the portfolio administration or portfolio management side of it, you can move on to the research team, but that isn't always a given that you'll be able to do that. So it's quite important to understand and just ask as you're applying to a job. Say, what is the day-to-day? Look on LinkedIn, who's worked there before that who can you get in touch with, perhaps a second connection, and just say, what's my day-to-day going to look like? Because actually, it's all of these financial terms are pretty impenetrable when you're coming in, and I certainly didn't understand the differences between wealth and asset management, but hopefully we've sort of touched on the main ones.
Can I just come back on that a second? And I think it's about understanding where you apply to. Because I work in a wealth management firm, but I don't do what Charlotte's been describing. I do asset management. So I've got a wealth management firm with an asset management firm embedded in it. So we are running open-ended funds. I don't spend anywhere near 70% of my time on relationship management. That would finish me off. It's not my skill set at all. So I couldn't sit down and have a 3-hour meeting with a client. It's just not what it's not what I want to do for my day. But there are people in my business that do that. So a lot of the wealth management firms do have their asset management division as a separate division within that firm, and because they will manage internal money for their clients, and that's exactly what we do. But some wealth management firms will only offer what Charlotte described, which is a relationship manager where you understand each individual portfolio, and you really don't make investment decisions. You're making much more tax planning decisions, and that is a different job. So that would be more of a wealth management financial planner job, whereas asset management, I agree with Charlotte, is much more managing a fund type of thing and making investment decisions. The difference in my job is that there's a slight crossover into wealth management in that occasionally I do see a very high net worth client. And we're in the same building, so there's a lot more liaison. So we maybe do understand a little bit more who the end client is. So it's maybe just a slightly different environment that's slightly closer to the end investor, but it's not hugely different, but there are different career paths you could take. So it's about making sure that when you go for those jobs, you understand the company you're going to and don't mistake the type of job that you're applying for. Be very clear about what it is. So yeah, try and understand that well before you get past that to the interview stage, because you don't want to pursue something that doesn't really appeal. If you don't like client relationships, it doesn't matter. there's still jobs in this profession for you. But if you do like them, then wealth management might be something to pursue.
Very much agree. Well, we're running out of time, but before wrapping up, I was keen to ask you a quick question to finish it all off. I was wondering what advice you would give to your younger self, or perhaps the people on the line. So maybe if you all just spend 30 seconds on that question, starting with Tatjana, maybe.
Oh, I mean, this is advice that, you know, I've received when I was younger, but I just find it is so difficult to actually implement. And that is, you know, ask questions. There are no silly questions. If you feel you know so little, you often don't really dare. I know, I think I ask now more questions than I did when I was younger. And I think it's partly to do with confidence, that you don't need to know everything. But really, I mean, if you're younger and you ask questions, I mean, nobody will hold it against you. It actually shows that you're interested, that you are thinking independently, that you want to know more. So, you know, by all means, always ask, because it will get you there much quicker.
Yeah, I would say that's exactly right. And someone said to me, you know, don't approach your career like an exam or like a sort of task to be completed. You're never going to get to your straight A's at A level that you're aiming for. This is always work in progress, and that's quite helpful as you go through. So I quite like the fact when we're interviewing people, the ones that come in and say, I'm so interested to learn, but I'm currently just, I don't know very much about investment at all, but I'm learning as much as I can, and I just want to find out more and to absorb. Those are the people you want to hire. And I think that you need that approach going through your career. You always need to be open to learning and realize that it's never going to be finished, and you're never going to reach level 10 and get a big pat on the back. It's you're going to be Warren Buffett age 89 realizing that you made a mistake by buying the airlines or whatever it is. So yeah, just always realize that it's never a job done.
What about you, Caroline?
Yeah, so mine is advice that I try to give to myself every day still, and sometimes I don't listen. But it's okay to say no. I think women particularly have an ability to take on too much, and that comes at the detriment of lots of things potentially. But it's okay to say no to the excessive amounts of administrative tasks that sometimes you feel that you need to do. It's okay to say no to things in your personal life sometimes that actually would take you over the edge, because actually it's a marathon, not a sprint. And I'm certainly guilty of just saying, yeah, I can do that, because I know I can do it and I know I can keep doing it. But then of course there is a breaking point. So actually sometimes it's okay to say no, to do something better than you would have done if you take on that extra thing. So it's about really understanding where you're going and why, and what's important to get to where you're going. And if that's your objective, then sometimes saying no to some of the fringe things on the way is the right thing to do.
Thanks, Caroline. All super helpful advice. I think we could go on forever because we all love talking about this, but we're running out of time. So thank you all for joining, Tatjana, Caroline, and Charlotte, and thank you for everyone who's dialed in. We've gotten a lot of questions, and I'm very happy about that. So I want to also just take the opportunity to say that we're doing more of these talks. We have plenty of other talks lined up in the coming weeks. The next one being on the 12th of May. So just go to our website, gainuk.org, to check out the full schedule. Those will be on various topics, and you'll have the opportunity to ask more questions too. So I would definitely encourage you to dial into those. We got a few questions about reading recommendations. Charlotte covered that briefly, but we also have more reading recommendations and lots of resources on our website. So tune in there, tune in to our Instagram channel, Girls for Investors, for replay of this discussion. And then if you want to be up to date with the latest developments on GAIN and be kept up to date on new talks, email Sophie at gainuk.org to sign up for our newsletter. thank you all, and look forward to seeing you soon.